Good morning and welcome to the Market Mondays webinar. My name is Kyle Rodder. I'm here with Danny Haythorne. We're both senior market analysts at Capital.com. Danny, good morning.
Good morning, Kyle. Good morning, everyone. Bright and early on this Monday once again.
Absolutely. So, of course, this is the latest episode of Market Mondays. Like you said, it's wonderful to have everyone's company. Danny, we may as well kick things off because it's a pretty busy time, of course, and it's likely to be a fairly busy week. We can perhaps just quickly start with the risk disclaimers. I'll throw in my Australian one, which is just to say that this is general information only and doesn't take into consideration anybody's personal circumstances. And maybe you can say a word quickly just on what's required from the UK.
Yep. So just everyone be aware, I'm sure you are, that trading leverage products, so in this case, CFDs, but for those of you in the UK as well, we offer spread betting. They are complex instruments and they do carry a high level of risk. So just be aware and make sure that when you are trading them, you are aware of these risks involved. If you
Brilliant.
want, I can take you through the key themes and then we'll go send it back to you to kick it off. But we do have a few points on the agenda today. We do have to comment on some data that came out last week. So we did have the US jobs data showing resilience. We still saw some jobs added in the month of May. And then, of course, the unemployment rate remain unchanged, stable where it was predicted. It's interesting, Kyle, and we'll go over this in a second, but to compare where we were a few months back. I think it was in the autumn or the summer last year, where we had that SARM rule triggering, and it kind of sent chaos into the market, thinking, the unemployment rate is going to skyrocket from here, and a recession is coming. And, flash forward to where we are now, we're still, again, just showing pretty resilient data. It's not great, but it's not awful. And I think, that's making it really tough for the Fed. But we'll go over that in just a second. We also had the ECB meeting last week, cutting rates as expected, but the commentary from Lagarde did kind of give an indication that we could see a pause in July, which markets already were predicting. We've also had some headlines in terms of Trump and Musk. I'm sure most of you are aware, but they were having a bit of a row towards the end of last week, and that did affect the price of Tesla quite significantly, dropping around 14% on Thursday on the back of those rows. It did recover on Friday, but it has sent a little bit of jitters into US equities. And then ahead on the calendar this week, we have the US CPI data expected to rise actually to 2.5%, as we do again have that tail end of those tariffs potentially rising short-term inflation. And then just a headline that's come through this morning, which we can touch upon, that supposedly the US and China are very close to talks towards getting a deal. So we can touch upon that in just a second as well. Kyle, I don't know if you want to kick things off with a little bit of a recap of last week.
Yeah, certainly. Sorry, I was just uh, having a look at Truth Social just to see if there was any updates on the Musk-Trump row. But effectively, yeah, I mean, we may as well start with the data flow, which is effectively to say that, I mean, I guess there was some fairly mixed numbers throughout the week. We had the strong job openings numbers that kind of kicked things off, JOLTS job openings numbers that kicked things off at the start of things. It became a little bit murky with the ISM surveys, which, clearly were weaker than expected and showed that there was, an impact of tariffs on the economy and business activity in particular. But, ultimately it was about the non-farm payrolls. And as you went through before with the numbers, Danny, a 4.2% unemployment rate and a jobs change of 139,000, which is a bit stronger than expected. It doesn't speak to a labour market that is, in kind of any kind of sort of boom mode, but I suppose the Fed wouldn't want to see that at this point in time anyway, considering the unemployment rate is relatively low, probably still, somewhere around where they consider it to be kind of, NAIRU or whatever it happens to be. For all the uncertainty of tariffs, for all the pessimism being reflected in confidence surveys and business surveys, the labour market up until this point has held up reasonably strong. There's the question of whether businesses are basically hoarding labor or at least holding on to labor with the view that eventually tariffs will be dropped and they'll be able to sort of push on with business as usual eventually. But nevertheless, I mean, it sort of suggests that maybe perhaps to President Trump's chagrin that there's not much impetus yet from the labor market side of things at the moment to lower interest rates any further. And I know we'll talk about it a little bit further on, but it puts the price stability side of their mandate into focus because so far, although there has been again signs of some weakening in the economy, the labor market is proving to this point fairly resilient.
Yeah, let me just share my chart if you want, just so our viewers can kind of get an insight as to what we're looking at. But we did see a little bit of a volatility towards the latter end of last week. This is the US 100, so the US tech, the Nasdaq for those of you viewing the chart. So we did see a little bit of a drop there on Thursday. As you said, we had some shaky sentiment figures. We have been seeing them for the last few months, and that's been gearing markets up towards more pessimistic actual data, whether that's jobs data, CPI data. But as we were saying, that the data on Friday, the jobs data actually providing a little bit of relief there. Again, nothing too significant, but just that stability in the jobs market, I think, is welcomed by equity traders. We can see here a little bit of a dip on Thursday. This was on the back as well, of course, of that row between Trump and Musk, providing a little bit of a negative bias to US indices. But you can see there that recovery on Friday. We're now once again nearing those highs that we saw back at the beginning of this year in February, before that strong dip that was caused mainly by that change in sentiment in US equities on the back of Trump's tariff policies. But you can see here that the US equity market continues to push higher. You can see the RSI is nearing once again that overbought area. So buyers are interested. It's just struggling to find a good reason to continue to be a strong buyer and very bullish in this market. And that's something that we've been struggling for the last few weeks. As you can see here, we've had that tendency to move higher, but definitely some resistance up ahead. And I think that jobs data, again, just failed to provide any meaningful direction. It continues to muddle things up for the Federal Reserve. And in fact, I think markets are now only pricing in one rate cut fully priced in for the remainder of the year. And I think there's about a 70% chance that a second one may happen. So again, those expectations continue to shift as the data, as time passes, and there is really no further insight from this data other than things are pretty okay. The economy is resilient. Growth has suffered, but it still remains to somewhat extent resilient. The jobs market as well, as you say, that might be skewed by everything that we've been going on, people hoarding employees, also in terms of orders because of the people trying to front run tariffs coming in. So the data does seem to be a little bit skewed, and that's muddying the waters as well for the central bank. So for now, equity markets seem to remain pretty interested, but struggling to find, I think, any meaningful direction. No short-term catalyst coming in. Now, elsewhere, we did have the ECB meeting last week on Thursday. Everything happened pretty much as expected, but Lagarde's messaging was seemed to be quite clear after the meeting. And you can see here, this is the Stock 600, the European equity market, looking for a little bit of upside here, again testing some of those highs that we've seen more recently towards the mid and end of May here. But just as a recap from the ECB, as I said, rate cut as expected. The three key interest rates were lowered 25 basis points. That brings the total to 200 basis points in the last year. So that's a significant move from Lagarde and her team. And Lagarde, a lot of the commentary in the press conference was, again, not providing too much insight, just saying that, everything is adapting to current situations. But a lot of the comments from the reporters were asking, well, what does this mean for forward guidance? Does this mean that you are comfortable to pause rates in July? Obviously, she's not going to say that explicitly, but the commentary that she did remark on a few times was, I believe she said something like the ECB remains well positioned at the current rate. They're going to continue having a meeting by meeting approach, guided strictly by incoming data. But she said several times the ECB remains well positioned at the current rate. I don't know about you, Kyle, but to me, that kind of gives you the insight that, yeah, a pause is likely in July. And that's kind of the view that markets took, that it's likely that the central bank will pause in July. Just after the meeting, we did see the likelihood of that happening rising to 78%, which is quite significant. And yeah, just Lagarde signaling that the growth remains resilient, but it is vulnerable to external shocks, specifically tariffs from the US, considering the relationship between the EU and the US seems to have soured since the last meeting. And of course, that's something to consider. But all in all, pretty good from there. And something that stood out to me was the fact that Lagarde kind of hinted towards the growth data that came out on Friday. We saw the Q1 2025 GDP figure for the Eurozone. This was a second. I don't. This was this second preliminary, or was this I think this was the final reading. Yeah, the final reading. And in the second preliminary reading, they actually downgraded the data from 0.4 to 0.3%. And Lagarde, in her press conference on Thursday, did hint that she expected it to be revised higher in the final reading, and that did indeed happen. We saw it revised to 0.6%, which actually marked the strongest quarterly growth since the second quarter of 2022. So significant there for the EU economy, considering it had been very, very shaky a year and a half ago. Whilst the US was still showing resilient growth, the European economy was struggling, showing no growth or 0.1% quarterly growth for a few quarters. So that did increase then once again the odds of a no cut. So no further cut in July to 82% from 75. Again, just suggesting that traders and investors are more comfortable with it, confident that the ECB will pause. And you can see here that push towards the end of the week actually coming from the back of that positive revision in Eurozone growth. Kyle, I might have bored you there speaking for so long, but do you have any views on this? As I said, from Lagarde's commentary, to me, a pretty clear indication that if nothing changes in the next month, we could see a pause from the ECB.
Well, you never bore me, Danny. You know that. But no, I think effectively what we can infer from the ECB is that they think they're basically towards a neutral rate right now. That the cutting cycle can kind of take pause for a little while they sort of assess the incoming data, and obviously the changes to the macro environment, which is effectively to say that we've spoken about it ad nauseum over the last few weeks. That one, the impacts of trade policy, US trade policy, are very difficult to predict. And not only that, the actual nature of the policy is almost unpredictable too, and whether there'll be any kind of further tariffs or aggressive trade policy going forward, or whether it will be entirely removed. So, there's kind of upside and downside risks for the central bank, which is very, very close to neutral. That, of course, if they, approach an environment which is going to be much more impacted by tariffs, it's going to want to have the option to be able to lower rates to support any kind of hit to growth. Also, it wants to make sure that it can assess the incoming price data as well, to see if there's any kind of serious inflationary pressures that have to be worried about. And the flip side too is that if they are somewhere around neutral and tariffs say get removed over the next couple of weeks or perhaps before the next meeting, then there is the concern that they're cutting a little bit too prematurely and they've lost the handle of the wheel, so to speak. All of those things sort of have to be taken into consideration. So despite the fact that the markets were sort of pricing in maybe another couple of cuts to come from the ECB before the cycle's ultimately done, it's pretty much a wait and see approach now to effectively assess the incoming data with rates at a neutral position or roughly neutral position. So it's all about optionality, I think.
Yeah, and Kyle, let me pull up the chart of Tesla. I don't know if you want to kick this off with I mean, Tesla might not be for everyone, but it is the most traded stock out there. So I think, regardless of whether you want to focus on Trump and Elon's back and forth and way of dealing things, a very public way of dealing things, then that's up to you. But at the end of the day, as we said, it is the most publicly traded stock, and therefore it means a big chunk of the market. So yeah, we saw things turn sour on Thursday, right? This is the Tesla chart here. We can see on Thursday, I think it dropped around 14%.
Yeah, it was down about 14%. It was a pretty big move. I mean, ostensibly, it's about, Trump's tax policy, which we haven't really spoken about over the last few weeks. It's sort of still sort of in Congress, with a few holdouts not really willing to, Republican holdouts not willing to support the bill, really on the basis of, roughly what Musk is saying, that it's a highly, well, he calls it filled with pork, so pork barreling, but, that it's fiscally irresponsible, we could call it that. I mean, he has some very kind of extreme views around, the US going bankrupt and what have you, and being rather concerned about that. But on the surface of things, and who knows what sort of personal animus may have developed over the last couple of months, within the administration. But ostensibly, it's all about, the big, beautiful bill. And the blow up more or less began actually with kind of Musk deviating from the Trump administration's line on the bill itself and becoming quite critical to the point where, of course, after some fairly subtle commentary and commentary sort of more pointed at Congress, he sort of threw some barbs at Trump himself. And but Musk's kind of very pithy refrain is that a bill can be big and it can be beautiful, but it can't be both at the same time, which is quite clever, quite clever marketing. But effectively the fear here is that he may have alienated himself with one, the White House, and that could, as was threatened by Trump on Truth, effectively uh, put at risk the subsidies that Tesla receives and also the business that it does with the US government. So, there was clearly a fundamental reason there. The other element too is that, Musk continues to alienate himself with basically everybody. So, there was the fact that over the last 6 months, or we'll call it almost 12 months since he become highly politicized, that there's one side of politics that have felt strongly enough against him to actually, go and vandalize Tesla vehicles. Certainly, we've seen an impact to their brand from his sort of strident views that have sometimes, caused some rancor and accusations of, fairly extreme ideology. But now he seems to have, also decided that he, wants to target the kind of MAGA movement to some extent. And there's a fear that again, you're just he's just alienating another base of potential Tesla customers. So that's the sell-off. I've been looking at the move, the social media streams this morning. There hasn't been much commentary from either men about the stoush. Most of it seems to be, fairly much in agreement about what apparently is happening in Los Angeles at the moment. But overall, again, it just shows that, although Musk is a huge asset in terms of this kind of premium that sometimes is in the price for the company, and the kind of meme value that he drives, the other element is that his behavior is definitely having a deleterious impact on the stock price. And, if he continues to kind of can, drive this tirade against Trump and alienate himself with the president, it obviously is a risk to Tesla's share price. And it is also worth saying too that it did turn the overall market into negative on the day that occurred, and even Bitcoin dropped by about 3 or 4%, which I suspect is just an indication that like you said, Tesla's a very frequently traded, highly traded stock. Often a stock that's traded with a lot of leverage, and that when you see such a swift move on such a company down about 14% on the day, might have been for the session, high to low for the session, but nevertheless, you get a bit of a deleveraging that goes on as well because people have to cover losses on their Tesla positions. So yeah, it's I suspect something that will be a flash in the pan and they'll move on from, but nevertheless, it's worth keeping an eye on just because, like you said, Danny, it's Tesla's one company that is a big sort of common thread throughout the market and also just very, very highly traded.
Yeah, as I'm saying, Tesla's a big chunk of the market cap, whether you want to focus on it or not individually as a stock, but it does impact the wider the wider sentiment in equity markets, specifically in the US. And as you say, look, it seems like we're over the worst of it. It was a spat that they had over the course of one day, maybe two. And most analysts are predicting this to die down. It's in no one's best interest for them to fall out. Some people are even saying that this could be all theatricals and it could be part of their plan. Um, Nonetheless, the impact in the market is done. And I think something that you were saying is that it's not only the fact that it's Musk's persona that's impacting the stock price. It also means that this row wasn't only just the the power play between them. It actually impacts the fundamental core business of Tesla. It could impact subsidies in the EV market, and that does have a real impact on the stock. So, yeah, the pullback did try to reverse higher on Friday, as both of them seem to kind of want to put the what happened on Thursday to rest. But there is still the real threat that Tesla's core business model could be impacted by this big beautiful bill, and Musk falling out with Trump over it isn't going to help. So it stands to be seen where this goes. As you were saying, no one really expected to go any further from here, but there is still the fundamental issue that the big beautiful bill could be bad for Tesla, and I think that's something that could come up and is likely to come up further up in the future. Um, should we look at what's coming up this week? I think we're at that point in the agenda. I
Yeah,
think,
well,
yeah, we were saying,
may as well start with trade policy, right? Because
yep.
very well timed that the eyes of the world will be on London, and not just because both you and I are working from London
Well,
office this week, but a few other important people will be in the city too to discuss trade. I mean, Kevin Hassett and a few other key Trump trade representatives more or less said that a lot of the discussion was going to center around rare earths, mostly just because there's a concern from the Trump administration around the security of raw materials for some pretty key products and their supply chains, and that was going to be the center of the deal. But Danny, I think the president may have even made a few comments about a larger, broader deal perhaps being on the agenda or at least not being too far away.
yeah, I'm not sure to what extent we've been able to look into this morning, but there have been some comments come through this morning suggesting essentially it says that US President Trump said that they are very far advanced on a China deal ahead of high-level talks in London on Monday, and that a China deal is complex but will bring in a lot of money. So whether they are specifically talking about rare earths, we don't know. There hasn't been any specification on that. It seems from the offset this could be just a general deal, which would be quite significant because, we've been saying for the last few weeks, as China and the US have gotten closer, we've been saying that this is essentially just kind of a strengthening in their relationship, but not necessarily a suggestion that a deal would be immediate. These comments would suggest otherwise, that, potentially we could be proven wrong and that something could be worked up pretty quickly. Yeah, I don't think we've seen that much reaction in the market so far yet in the opening session, the futures. Let me just pop onto the equity markets here. You can see, for example, if we're looking at the Asian market, we're seeing that move higher. Potentially, this could have been brought on by just that positive sentiment reiterated. In terms of futures markets, we're not quite seeing that impacted yet in Europe and the US. So I don't know, Kyle, how do you think these markets could open up today on the back of that news? If this were to be true, it's pretty significant, right?
Yeah, I'm sort of skeptical as to what extent they'll be able to arrive at a sort of a broader deal today. I think China feels as though that they've got enough leverage in the situation and currently at the upper hand to be able to hold out a little bit and draw out the process if they need to be able to arrive at an outcome that they find satisfactory with, some concessions. Again, there's been certain things that have been sort of floated over the last few weeks that, China could do on a piecemeal basis to try and appease the Trump administration. But I mean, it has to be said, if we do get rhetoric that is fairly positive and suggests momentum in talks, that's going to be enough to be able to boost markets, I think, to start the week. And I mean, effectively, I think it's been true since the middle of April that for everything that's going on, the real critical factor as far as the narrative is trade policy, and that the markets will buy into positive trade developments and the prospect of deals coming through. And of course, they'll sell off in situations where that seems to be threatened. But for the most part, we've seen that kind of dynamic play out that, the proverbial wall of worry that the markets are climbing is pretty much built on foundations of trade war uncertainty. And as a result, the less uncertainty that happens to be, the higher the markets will climb. So it's yeah, going to be an interesting one to what extent there will be a broader, more general deal. But even if we do see something on the rare earths front that, suggests that them at least be able to negotiate something, a deal on something, then that in and of itself might provide hope in the markets and optimism that there's sufficient goodwill and again momentum that further deals will be made down the line, and that, obviously the pause in tariffs that, is currently slated, I think, to end at the end of July, if I'm not mistaken, for the China tariffs, might end up being sort of a prolonged détente, I guess you could say.
Yeah, before we move on to US CPI, which is the key data point for this week, I think it's a good moment to bring in a question we have talking about these trade talks. The question specifically is, can we expect copper to go up if US-China trade talks are positive? From the offset, I'll just kick this off, everyone. From the offset, let me pull in the copper chart first, just so we can have a look at it. From the offset, yes, copper is often used as a barometer of economic health, and you would expect a reduction in tensions to provide a positive impact in the overall stock market and sentiment in the market. So yeah, from the offset, you could expect the positive developments in talks between US and China. Obviously, it will depend on the extent of it and the areas it covers, as Kyle was just saying. But from the offset, I think the general answer would be yes. I think, something to watch out for as well, of course, is the fundamentals in copper. And it is currently trading in a very tight physical supply environment with regards to inventories. And there's also very strong demand, I believe, specifically from China, with all of the green energy stimulus that we've been seeing. So I think it's definitely something to watch out for. Any breakthrough between US and China would ease fears on, supply chain disruptions and also just economic impact on the market. And I think that would be positive for copper in itself. There are other implications to look out for, which of course the performance of the US dollar, which is trading in dollar, that could have an impact. Any further commentary that we may see from them, and also you've got to watch out for situations, let's say buy the rumor, sell the fact situations, which do create a little bit of volatility and unpredictability in the market. But yeah, just from the offset to answer that question, I think you could expect the improvement in relationship between the US and China to improve the price of copper. Kyle, do you have anything to add?
Just only on the supply side element, which is obviously independent of these trade talks, but one would expect that yes, if trade barriers and tariffs in China are dropped and are dropped on a sort of a sustained basis, that that should improve copper demand and therefore see a bit of a push higher in prices. The other element too is that copper's been very sensitive to these tariffs on steel and aluminium and other metals from the United States. That's a supply side concern too. So those tariffs were jacked up to 50% last week and was a bit of a sort of a tailwind for the market as well. Again, a supply side question. But going back to the original question, any kind of development, I think, between the US and China about arriving at a deal will inevitably be good for global growth. It'll inevitably good that will inevitably be good, therefore, for copper demand. And one would expect it to be fairly sensitive to those headlines if they happen to materialize today or throughout the week.
Yeah, and let's go, before we drag this on too long, let's go to US CPI, which is going to be the key reading for this week. I'm seeing through the net. Expectations are for headline CPI to rise from 2.3% to 2.5%, core CPI from 2.8 to 2.9, and with a small increase in the monthly reading. So yeah, brings it back once again to the, I guess, resilience in the US economy. Now, some will question now whether this is actual resilience or this is the impact of trade barriers on the US economy, which could have a skew effect. We've seen the Federal Reserve warn about this in the past. They do expect short-term inflation to rise slightly on the back of the impact of these tariffs and, the expectation of. We've seen a lot of companies front loading some orders and spending just to avoid the implementation of these tariffs that could have skewed the data. But of course, that will make the job harder for the Federal Reserve. We've been saying that throughout the webinar today. It's a case of how much of the actual data do they take at face value, considering they are expecting external influence from the US political environment. So yeah, markets, I think, will be looking out for this. Exactly how that impacts market might be a little bit trickier to view. You would expect that stronger CPI reading to have a positive impact on the dollar on the offset, just because it lessens the likelihood of a rate cut from the Federal Reserve. But again, the dollar has been pretty much a sell story in the last few months because of those concerns about the US economic environment and the impact of trade policies. So it might be a tough one to try and position ahead of the data. What do you think, Kyle?
Yeah, I think it's going to show, or it's expected to show stickiness effectively. And arguably, it's been a dynamic that's played out for if not months, perhaps, but the better part of a year. That inflation, and of course, this is the CPI read, not the PCE read, which is the Fed chosen inflation gauge, but you knock 3 or 4 basis points off the read and you get pretty much what the PCE is. There's a degree of stickiness and perhaps a re-anchoring, arguably, of inflation around these levels in the CPI's instance, core CPI somewhere around the kind of high 2% level. The devil will be in the detail, I think, because a lot of the stickiness in inflation up until this point has been in the services sector, and that's just been an indicator of resilient demand in the US economy for quite some time. But we'll be keeping an eye on areas that are a little bit more perhaps sensitive to tariffs, the goods reading or price pressures in kind of goods areas will be very significant because that might tell us if there is kind of a pass-through effect happening from tariffs already. And, the situation with tariffs is that it's, technically in and of itself, not inflationary. It's a price shock that'll change the price level on a one-off basis. But the problem is one twofold. It creates a lot of noise in the data that it'll make it rather difficult for the Fed to potentially cut interest rates through such a price shock without, and this is the second point, some risk that inflation expectations might become a little unanchored, and this stickiness that we have already probably witnessed before, the emergence of tariffs gets a little more entrenched, and maybe we even see some upward pressure coming through on inflation. So, in saying that, just contrasting to last week, I think might have been last week or the week before, where we got Eurozone inflation data, which was expected to show a little bit of a jump, but unexpectedly fell, contributed to a bit of an uplift in European equities. If we do get a downside surprise, effectively, like we said at the start of things, the jobs market isn't giving the Fed at this stage any reason to lower interest rates. It's stable enough for them to sort of justify keeping things on hold, if nothing else. If the price side of their mandate starts to improve, effectively it creeps a little bit closer to 2%. We get a downside surprise and evidence that tariffs aren't creating a major disruption as far as price stability goes yet, then that's going to be a positive influence for equities. You'll see probably the dollar, shift slightly to the downside on the basis of that as well. And those expectations of a rate cut by the end of the year, which is still priced in, although obviously being sort of pulled out slowly from the futures, rates futures is going to increase. So it should be fairly influential. I mean, obviously, any kind of trade development and headlines will end up being the biggest thing for the week, but of course that's highly variable, and we can't say if that will happen or not. But as far as headline risk and event risk is concerned, the inflation data is the clearest thing on the calendar that will likely move markets.
Yeah, I think I agree. The downside surprise would probably provide the most impact in market, as you say, likely giving equities a reason to try and push higher once again, basically on the back that we are expecting the talk has been that the tariffs will provide price shock. And if the data were to contradict that, at least in what's been happening up until this far, I think markets would take that as a good thing. And yeah, it doesn't make things that much easier for the Federal Reserve, but it would potentially remove some of the uncertainty with regards to their price mandate, and that would potentially allow markets to price in a little bit more expectation of rate cuts in what's left of this year, and therefore allowing equities to push higher. Whether that's a sustainable move or not, that stands to be seen. But at least in the short term, we could see that impact in the market from, as we say, potentially a downside surprise if that were to materialize. We've got through the agenda. I think that's pretty much it for this week. We've been rambling on for about just over half an hour now. So if you've got nothing else to add, Kyle, I think we can leave it here and wish all of our listeners a very good week, a very good trading week. We'll be back here next Monday as always. Kyle, it was great to see you.
Yeah, it's great to see you too. Hopefully see you very, very soon.
Bye, guys. Thanks for joining.